All right, ladies and gentlemen, I hope you're having a wonderful weekend. I am really excited to share this video with you. I encourage you to watch all of it. This is going to be a real hands-on, in-depth lesson with options. This is not clickbait. It's going to be going over how to find 1,000% options, or at the very least, understand what it will take for every single option to go 1,000%. So this is going to be really, really cool. You guys have been awesome. Thank you so much. We are literally about to hit 50,000 subscribers. So this is my thank you to you all. So I can't tell you guys how much I appreciate every single one of you who like the video, comment on it, are there at the streams, even giving me ideas. You guys are the best. Even the people sending me emails. I know I don't get back to everybody, but honestly, you guys are amazing. God bless all of you. I am excited and honored to see where you guys go with your trading journeys, and if I could help out any way possible, I'm blessed to do so. So thank you for everybody. Thank you for the people inquiring, always wanting to learn more, and just being overall positive, you guys. That's what it's about. And if I've inspired you or educated you in any way, hopefully you do the same to other people and just return the favor. Be open, spread financial information. Don't ask much from people about it. If people want to learn, give them an outlet, give them a way, show them how to learn and how to get into this stuff. Be responsible and understand everything associated with trading, and learn. So I love you guys. If you do find this video helpful here too, post this anywhere, share it with someone, because we are going to talk about really the basics of how option trading works and what to be looking for when it comes down to this stuff. So subscribe, like, do all that if you are new, and if you are new, we're glad you're here. And make sure you check out the live streaming channel. We are live Monday through Friday, 30 minutes before open. It is the first link in the description, and it's pinned in the comments, so you could come tune in and watch us trade live and ask your questions. So let's get into this. So I'm going to spend the first half going over a little bit of the basics of options, but we're going to overlook a lot of things, and we're going to really get into some of the more, I guess it's going to be intermediate, not really advanced, but again, if you are a beginner, this will be helpful. And then the second half, everything I talk about to show you, because again, the purpose that I'm trying to show you guys is understand what you're buying. You've heard me say this a lot, and this is the problem I think a lot of option traders have when they first start out. You guys are just buying these contracts, and you're like, okay, I buy this at this price, I'm going to sell it for more money, or if the stock goes up, I'll do this. In the money, IV is a result, not a cause. IV is a result, not a cause. I want you guys to understand every single thing you're meaning, and not understand that it's a big word, but literally what it means. So one of the biggest concepts we need to discuss here is being in the money. So I'm going to talk about this factor and how it relates to everything. And then the second half of this video, we're going to cover this. I literally have a formula. This is on Excel, to the point where literally you fill out the price of the stock, you fill out the strike price you're going to get, how much it is, and then how much you need to go, and it will literally tell you exactly what price to the stock needs to go. So this may be cool, and you guys are like, whoa, like, just give me that, I want to learn that, like, where can I get the tools, can I download this, do you have a course? No, tools are awesome, but again, you guys know I'm trying to further education and learning here. A tool is not helpful if you don't understand what it's doing. This is like math class. Yes, you could use a calculator all day, but if you can't show your work and don't know what it's coming down to, that tool will hurt you more than it will help you. So please, man, if you guys really want to understand this stuff, I encourage you to understand how the tool does it. The tool just does this whole Excel model I've created with it. It just helps you do it faster. And actually, this was created by somebody in the TTF a few years ago. Shout out Mustafa. I taught him this whole thing, and then he pretty much threw it into this model and was able to make this happen here. So again, if you understand what is happening with this, you could create this exact Excel formula yourself on Google Sheets or on any Excel. It's very, very easy to do. I'm not good at math, so I didn't know how to do this. So people who are good at math, you guys have certain skills, and that's why I look to share this information. You guys could always add stuff that I've missed or I'm not even good at, and everybody else. So, shout out to Cope, baby. And two, you guys will see the name of all this is called the Josh Scholes model. So just like the frog or anything, this is another thing I've invented and made up myself. So hopefully we keep the culture and name behind it. But if you don't know, the Black-Scholes model is actually the statistical way that option pricing is calculated. So it's very complex and confusing, calculus, all this, whatever it may be, but this is now the Josh Scholes model. So let's get into it. All right, so I think we're going to use Starbucks as an example because it's near $100, and this is going to kind of hopefully keep it easy. So bear with me here, but let's start with what an option is. And I'm going to look at calls first, and pretty much only calls, just to keep everything very simple. But you need to understand what you're buying. An option is the right to buy something. So in the case of a call, an option is a right to buy the stock at a certain price. So a lot of people always ask, what is the market pricing? How do you know what the market is saying? Or how do you know if an option is a good deal? The answer to this, and this is a big option, very beginner concept that a lot of people overlook, and this is what we're going to have to understand to predict 1000% options. And the answer is break even, your break even price. So let's work through what break even is. An option is a coupon, my friends. If you hold the coupon, it lets you buy a stock at a certain price. So looking here at the calls, the coupon expires on the date. That's the expiration date. Starbucks is trading at $96.42 right now. If you hold, let's say, a $100 call, or now a $98 call, that is a coupon. And the coupon says you could redeem 100 shares of Starbucks at $98 if you own that coupon. So it doesn't matter if Starbucks is trading at $200, $150. If you hold the coupon, you get to redeem it at $98. Awesome. But now you would ask yourself, if Starbucks is trading at $96.42 and you could get 100 shares of Starbucks anywhere for $96.42, would you redeem that coupon, or would you pay someone for that coupon? Probably not. But don't get too hung up on that. Just let's move forward here. The thing is, now, to get these coupons, you pay for these coupons, right? But again, now if there's time left in the contract, and you know how stocks move, anything could happen. You know, the stock could move up $10, $5, who knows? And again, the answer to what is the best price, or how do you know this is a good option, it depends on the stock and how that moves. So that's why, even though the coupon isn't really worth anything now, it holds a worth in the sense of time value. That's why people are still charging $36 to sell this coupon. But the key is you pay for these coupons. Again, the 98 call allows you to buy 100 shares of Starbucks at $98. You don't get that coupon by it just showing up. They don't give it out in the penny saver. Does anybody use penny saver anymore? I don't know. But you can't get your hands on that without paying for it. So you pay a certain amount of money. How much you pay for it, or whatever they're going for said coupons, is letting you know what they're worth right here, right now in the current marketplace. So that's also, and again, at the end of the day too, this is also going to tell you what people are expecting this stock to do, if they're willing to charge, or if they're willing to pay for it at this point. That's why when you see an option for 4 cents, there's a reason why people are only willing to spend a little bit of money. They don't really think it's going to happen. If it's kind of like $30 in the middle, that's like 50-50. And if it's closer to the money or in the money, and this is a concept we'll discuss, don't get confused if you don't know in the money, but this is signaling what people think it's going to be worth. So now you make money off the stock going to a certain price, and then you redeeming the coupon. So again, in the case of the 98, let's say, the stock goes up to $100, and then guess what? You have the lucky Willy Wonka golden ticket. You own this coupon that says, hey, I could buy 100 shares at $98. It's going for $100, so you can't buy Starbucks share cheaper than $100 now, because that's what it's going for on the market. But you have this coupon saying, I get the shares at $98. Boom, you just made $2 per share on $100 on 100 contracts, and now that's a $200 profit. So again, you make money off of the stock going to a certain price, and then you having a coupon that gives you the stock at a better price, or pretty much an area that lets you profit off of it. That's how we're making money on these. But now the biggest key you have to factor is what you paid for the option, hence your break-even price now. So let's say you have this 98 contract, but you bought it at $36. Even if it goes up to 100, yes, you could sell it now. You buy the stocks at $98, you sell it at 100, you make $200. Did you walk away with $200 profit? Technically, yes, but your net income on that deal, you got to factor in your cost. You paid $36 for it. So subtract that $36 from the $200 you made, you're left with $164 net profit. That's how much you really paid. Because again, if you use the coupon and redeem it, that coupon disappears, but it doesn't change the fact that the only way you got that coupon was you paid for it. So even though now it allowed you to buy the stock, you went and you bought the stock for 98, sold it to the next guy for 100, you still paid for that contract. Now this is where it comes into break even. Now that's one scenario with break even. I'm showing you if all went good and you profited off of it. But your break even price is very, very important. This is saying now, if you did buy this contract, so now when you look at any contract, break even is very simple. It's factoring what you paid to acquire the contract, and it's letting you know, hey, if by the time this coupon expires, if the stock doesn't go to this price, you're going to lose on that transaction. So like, let's reverse the situation. You bought this 98 call and Starbucks never goes up to $100, well, whether you bought this contract, you're going to lose the money you spent. And even then, if you just don't even factor what you spent right off the bat, if the stock is at $96 and it never goes past 98, there's no value to it. There's no way you can make money off of this coupon. It's a stupid coupon. It's a dud. So that's the end of the story. But now, the only way you're making money again on these coupons is if the stock goes to a certain price. So now in this case, if it's a 98 and you bought it for $36, you need the stock to go to 98.36 just to make your money back. That's your break even price. Because again, let's say now the stock went to $98 by the expiration and you're like, okay, cool, I get the right to buy it at 98. Well, if you get to buy it at 98 and you sell it back to $98, sure, it went up to the price the coupon was at, but remember, you spent $36 to get that coupon. So you actually lost $36 because you spent money on the coupon, even though the stock never went there or it went to that price. There's no profit margin. And again, do you guys see? This is like running a business. It's like a restaurant. If it costs you $5 to make the ingredients of a burrito and you sell it for $5, you don't make any profit. If you sell that burrito for $10, it costs, even though you would get $10 from the customer, you have to factor in what you spent on the ingredients. You're left with $5 of real net income, net profit. But in this case, if it doesn't reach you have a break-even price on that burrito. Again, if it costs you $5 to make that burrito, you have to sell it at $5. That's just to make your money back. If you sold it at $4, if it cost you $5 to make it, you would lose. So that's what's happening here. When you buy an option, that's the cost of your ingredients. So essentially, and the only way you can make money off the contract, if it gets to that certain price, and then again, every dollar above that price, you start to make money on it. So you would need the stock to go to 98.36. That's your break-even point. That is the point not to which you profit, but that's the point to which you make all your money back. So now come September 6th, if this stock isn't at 98.36 and you bought this right here, right now for 36 cents, if it's not at that price, you lost money, no questions asked. Any dollar above 98.36, that's going to be your real profit that you're going to walk away with. So it's very simple to factor break-even. You take the strike price and add what you paid for it. So in this case, the 98 contract, you bought it for 36 cents. Add that 36 cents to the back end. Boom. You spent, your break even is 98.36. You see this 97 contract, you bought it at 75. Your break even would be 97.75. You bought this $100 contract and it's going for 6 cents. Your break even is $100.06. So it's saying there's no way by September 6th, if Starbucks is not at $100.06, you lost your money, no questions asked. Now there's other factors that could say, let's say tomorrow Starbucks shoots up to 98 and there's still time on the contract. This contract might go up in value, but that is because people are changing the value. We're not talking about that here. Really, I encourage you to leave that out of the equation for now. That's where you get complex and confuse yourself, because it doesn't matter what it does on Monday or Tuesday. Come Friday, come the expiration date, if you paid 6 cents for this contract, and it's the right to buy 100 shares at $100. If the stock isn't at $100.06, you lost the money. That's it. Very, very simple. So this is break even. Now let's go back to the top. What is the market pricing? How do you know this is a good deal? How do you know what the market is pricing? By people charging 6 cents for this one, or by them charging 36 cents for this contract, you know what they think is realistic or what's going to happen with it. Because now come with a week left on this contract, if they're charging $36 to get this coupon, if they thought by the end of the week that Starbucks would end up higher than $98.36, guess what? They would charge you more money for that. They would charge you $1 for it, $100 for it instead of 36 cents. If they thought it was unlikely, they would charge you less money for it. Because why would they sell the contract? Why would they give the coupon up for not an amount they thought that was reasonable, that was going to even leave them their own profit margin? But again, that's the whole, do you see, this is diving deeper and deeper and deeper, and this is what happens with options. I just wanted to keep it simple for you guys and understand what break even is, because this is the necessary part to understanding and valuing and finding out what your contracts are exactly going to be worth. So hopefully you're getting the gist of that. Now the next important part is, we figured out what break even is now, so that is always going to be a concept that you need to factor in, because what you paid for your ingredients, what you paid to get the coupon, is always going to be important to factoring how much you made, even regardless of what the contract is worth. But now the next concept we need, and again, this is all getting into the Josh Scholes model, so hopefully you're following along here, but the next thing you need to know is in the money, ITM. This is now when you're in the money. You could see here on an option chain, this is when it turns blue, but in the money now means that the coupon is at a lower price than where the stock is at, or again, it depends if it's a call or a put. Here we're looking at calls. So in this case, you see the stock's at 96.42. The option of the 96 coupon, the 96 call, that's 42 cents in the money. So how much it's in the money is pretty much letting you know the value it has. And now that is the key. If something is in the money, it has intrinsic value. That's one of the keys here to finding out the value of your options, because now come expiration date, if let's say today was the expiration date on this and the stock closed at 96.42 and you owned a 96 coupon, sure, even though it's saying it's going for $1.35 now because there's time left, but if it is 42 cents in the money, no matter what, this contract would have 42 cents of value, because you could go buy the stock at $96 with this coupon and sell it at open market for 42 cents. So think about this now. Hopefully you could see how this starts to factor in how to find 1000% options and how to understand the value of your options. Whatever you paid to acquire this option is going to give you a really, really good idea of what your percentage was up. So let's say you bought it at the same 36 cents as the 98. Well, if you bought it at 38 cents and it's 46 cents in the money, you actually would be having only an $8 profit because you spent 36 cents for it. But now let's say you spent $1 for it. If you spent a penny for it and it's at 46 cents intrinsic value, or 46 cents in the money at expiration, you would make $45 net profit. Or now let's say you spent $135 on it today and the stock ended up at the same price, 96.42, you would actually lose money. So this even goes to show how some of you guys, you could buy the exact same option as somebody, but if you buy it at a different time or a different price, one person can win and one person can lose, because they just bought the contract at a different price. So now that we have it, the key to predicting options here is getting in the money. So this is where we're about to pick up speed. Hopefully this makes sense to you guys right now. The key to predicting option prices, or knowing what an option will go to or what it's going to be worth, is factoring in the money. You need to know what you paid and how much it's in the money. As long as it is in the money, you get intrinsic value. That is all you need to know. Time gives it value, sure, but we're too stupid to value time. You know, it's like if it does shoot up and it gains that that's why it's called extrinsic value, because it could still, the contracts, all of these, none of these contracts are in the money, but they still have a price for them. But again, come Friday, that's why all the contracts expire worthless if they're not in the money. It's hard to value time. We're very, I don't want to say stupid, but it's just, that's the only way I like to phrase it, that extreme, so you really get to understand that there's a lot going into it, and really just think about it. You know, how much is your time worth? How much is your life worth? You don't know what you're going to do tomorrow. You don't know what you're going to accomplish in life. I've seen some people do very, very good in life, and then they end up becoming bums. And I've seen bums turn it around and go crazy. You don't know what somebody could do with time. That's a hard thing to value. So especially imagine in the stock market, you don't have calculus. You don't know this. I'm bad at math. I could go with what I know. As long as it is in the money, you know it has that value because it's a coupon. So as long as you don't have to say, well, what's this coupon worth? If it's $100 in the money, you know exactly what it is. So come expiration, if an option is 50 cents in the money, it will be worth $50. If it's $1 in the money, it will be worth $100. There's no question asked. It's because one option represents 100 shares, and if you could buy it at $1 cheaper than what it's trading at, whether you sell it at open market or you sell the contract or go to your broker, you're going to get that money worth it. So then all you need to know is what you paid for the option and what it's going to be there. So this is what the goal is. That's why the whole goal, I've always said, if you've watched the videos and stream, the goal is to pick an option that will get in the money and stay in the money by expiration. So if you pay $10 for an option and it expires $1 in the money, that option will be worth $100. I put open. That option will be worth $100 and it will be 1,000% gain, no questions asked. See, the key is what you paid for. If it's $1 in the money and you paid 80 cents for it, you're going to make $20 instead of the other difference between it. That's why what you pay is important. That's why when some people buy options that are really high priced, by paying an option that already went up 500%, 1,000% in value, your break-even price is increasing. So if the stock isn't above that break-even price and then more, it's going to be even harder for you to make 1,000% gain on it. But if you spend for a low amount, all you need is to get $1 in the money on that contract to make that 1,000%. So hopefully that just set off a light bulb here, because that's all we have to figure out now. So this is what the Josh Scholes model is going to predict. This is what I'm trying to show you. If you want to predict 1,000% option, it's not rocket science. It's basing on what it's going to happen on Friday. So take a look. Let's go with this 98 call we've been looking at. So Josh, how do I make 1,000% on this option? Well, think about what you got here. So if this is a 98 contract, you only make money on this if it gets in the money and goes there. So if it goes $98, if it gets to $98 by Friday, how much money will you make? You'll make nothing if it goes to 98. So you're paying $36 for it. 1,000% is 10 times. That means for you to make 1,000% on this Starbucks contract, you need this contract to go to $360. That makes sense, right? Because again, if come Friday, if Starbucks is trading $3.65 in the money because you paid 36 cents here, you got 1,000% no matter what. So take a look here. If you bought the 97 contract and you paid 75 cents, you would need to be $7.50 in the money to make 1,000%. But let's go back to this 98. So again, you pay 36 cents for it. By expiration, you need it to be $3.60 in the money. So take 98 plus $3.60. That means the Starbucks contract here by Friday, if you bought this at 36 cents, no matter what, no questions asked. Again, hopefully this math is making sense. If Starbucks is trading at 101.60 by Friday, this contract will be worth $360. It will go up 1,000% from where it's at right now. So continuing along this logic, if we know now that the stock has to go to 101.60 to become 1,000% gainer, you just got to do the math now. So let's start back at $98. Divide 98 by $3.60. That's the dollar movement we need. I did the math wrong. You do $3.60, divide that by 98. Boom. That's a 3.6% move. So now that's actually not too bad. This may be a good one on Monday. We'll see. But then you have to factor how much does Starbucks really move now in a week. But this is telling you, if by the end of this week, if Starbucks moves 3.6%, this contract will go up 1,000% no matter what, no questions asked. That's literally a fact. This isn't an opinion. This is what I'm hopefully you guys understand. This is how options work. You know what you're buying, because if I buy this coupon at $36 today and it moves up 3.6% in the next 7 days, and it closes up there, and it closes at that 101, it will be $3 in the money, and I bought it for 36 cents. I'm going to be making 1,000%. That's it. So boom, you could do that with any contract now. So think about that. That was 3.6%. Let's try it with another contract here. And now again, you don't have to be 1,000%. So think about this. I'm calculating 1,000% here. So if we did this with the 97 contract, you would have to literally get $7.50 in the money if you bought it at 75 cents. So 97 plus $7.50, that's 104. So that's a higher price than this one. So again, think about it. We're talking percentage returns. So if you want to make 1,000% on a bigger number, you're going to need to go a few more dollars in the money, even though this was closer to the money. So you would need to go a 104.50 to make 1,000% on this contract. But now let's do that a different way. What if you wanted to only make 500%? And now do you guys see? This is where the Josh Scholes model, this is where the Excel will come in, but you could do this all in your head. This is where you could all figure this out. So let's say, okay, well, if I'm spending 70 cents, I only want 500% now. So 75 times 5, that gives us $375. So that's a little bit better because now that's saying you need to only be $3.75 in the money for this contract to be worth $375 by expiration. So let's try that. 97 plus 375, that equals 175, a dollar lower than here, minus that by 96.42, because that's where we are right now. That would be a $4.33 move from where we're at. So divide that 4.33 from where we're at now, 96.42. That would be a 4.4% move. So now if this stock moved 4.4% from where it's at here by the end of the week, this contract would make you 500%. And I think actually now after doing that calculation, I think I did the 98 one wrong because I multiplied the $3 by 98 versus $3 by 96. So let me try that again here. Because remember, we said we need this thing to move $3.60 in the money on the 98. So again, we'll do this again so you could see that $3.60 would be 101.60 minus 96.42 because that's where the stock is right now. That's $5.18. Divide that by 96.42. Yeah, that's 5.3%. Remember, because that's what we said when we first did it, I divided it by $98, but the stock's trading at 96. That's why I was like, damn, 3% move or 2% move for 1,000%. That looked like a good deal, but now actually for this contract to go 1,000%, the 98 would have to move 5.3%. So there you go. Isn't that funny? Even by making that mistake, it answers this question: how do you know this is a good deal? Because now going back to that, we could calculate this with any option. Now, this isn't just about finding 1,000% plays. You could do this calculation with any option by expiration and say, well, what would it take even for me to make my money back? What would it take for me to make this much? You guys could set your targets or anything, but that's why earlier when we first did it, we did the math wrong. And if it was saying, though, that it only took a 2% move in a week to make 1,000%, that's a good deal. But now it's saying 5%. 5% is double the amount than 2%. Not too many stocks move 5% in a week and stay there. But there you guys go. Hopefully you're seeing this is how you price everything in. So this is how contracts gain the value. So now let's go to another example. Let's pick another stock, and then we're going to pull up the Excel sheet so you guys can see how it works. So I'm going to use Boeing because I think this is a big one. I love Boeing, and this is a one because it has all this news, and it's driving up and down, and it could move big, but sometimes it usually moves slow. So now, again, to answer the question, how do you know this is a good deal or not? This is where your experience of what the underlying stock does. So don't expect to figure this out right away. This is why, you're on stream, you're learning, you're paying attention. You get experience in the market. You'll start to learn what stocks do what sort of things. And honestly, I've showed it. And here's a little quick example. This is one of the quickest ways you could read it. Look at an option chain. You see Boeing, the strike prices are $2.50 apart. When you see an option chain like that, the chances are when it's a bigger spreads between the option or a bigger distance between each strike price, that lets you know the stock somewhat moves a decent amount. Whereas if we go back to Starbucks, its increments are in 50-cent moves. That's telling you the stock doesn't really move a lot. So 5% is a pretty big move for that company. But let's go back to Boeing now, and we'll see one of these options by September 9th. So think about it. You're spending a lot more money on these contracts. So let's go here. Let's say you wanted to get the 380 call. Again, and before I show you the Excel, I want you guys in the habit of just looking at the price. So it's a 380 for 50 cents. If you bought that call for 50 cents, you need the stock to be $5 in the money to make 1,000%. But let's say you're not a greedy bastard. Let's say you only want, instead of 1,000%, you want 500%. So that means it has to be $2.50 in the money. So that would be $382.50. That's what you need the stock to go up to. Because again, if it's at $382.50 By expiration, this contract will have $2.50 of value. So take 382.50, minus it by 363.80, you're left with $18.70. Divide that by 363, the current price it's at, and boom, 5%. So guess what? If this moves 5% by Friday from where it's at now, you're going to make 500% on that option. Boom, bang, boom. Argentina, boom, ba, boom, ba, boom, ba. But hopefully you guys are seeing you could learn. And now let me give you another caveat to this. Think about every day. Every day and as the stock moves, because now we're saying it's from here, right now. If Boeing goes up $10, this is going to change everything. The price will change, and again, the distance it will take will be a lot different, or vice versa. If it falls further away from the money and the stock goes lower, this will instantly change. So just because now you know what it will take to go to 500%, 1,000%, doesn't mean you know what the stock's going to do, and doesn't mean that won't change in a heartbeat if the stock makes a move in the opposite direction. So keep that in mind. But now let's get to the Excel sheet. So here's the Josh Scholes model. This is how to do it. So literally now, as you see here, it says only change the yellow. This is why I haven't released it to you guys yet, because I don't want this to do this. And you could even see they had in the past, some of the students took notes. They said look for $20 or less stocks for cheaper options, but it works with every stock. But there is a key here with some of the lower price stocks. The options are going to be a lot cheaper, because the key is how much you're paying for the option. Because now this is the key to finding now more 1,000% options, is that if you buy the option for a less amount of money, to get 1,000%, you only need it to go $1. And that's the key, is the amount in the money. So again, if you spend 45 cents for the option, 1,000% is $4.50 in the money. It's easier to get $1 in the money. That's by far the default. So if the option is 10%, you're going to make 1,000% on it. So that's why some of the smaller priced options, we're talking like $20 and under stocks, you could get yearly options for like 20 cents, 10 cents. You only need them to go $1 in the money. And that's a whole nother theory, so I won't talk about it too much, but it says, look 10 cents or lower options at reasonable strikes. Low priced options equal more gains with less risk. This sound familiar? I'm telling you, this is from almost 5 years ago, my friend. So the strategy and the things I've been teaching and going over, we've been sticking to it pretty solid. So be careful of going and spending a lot of money on options, man. If you've traded options a long time and know it, there's risks and probabilities, and some people like in the money, this and that. I do my thing. I do it my own way. I've been, penny pinching on the options for a long time here. But then the key is now look for a realistic move, and this is the highlight to all of it. You need to have a realistic move, 30% or lower, and 30% is high. But even at the end of the day, it depends on the time frame. Like if you have a year to move 30%, that's not as unrealistic versus 30% in a week or 30% in a month. But anything now, once you start getting crazier, that's where it starts to get higher. But like it says, 1 month out is more risky. The more time, the better. Watch out for decay. Make sure to buy the correct strike price. So it's saying look at, not final. So it's saying, do the math in your head too. A lot of this stuff could change, but again, you don't buy the price to reach, you got to buy it below. So let me show you the real key with that. It's saying now, if you expect it, and this is how you could start, there's one way, and now this is the key to all of this. Again, I know I haven't showed you how the model worked, but hopefully you see I gave you everything. You already understand it now, but I'm trying to now show you how to tweak this and use this to your advantage. It's not about just saying, okay, will this option go to this price? If you could see a stock and you think it's going to go to a certain price, once you figure out what price it's going to go to, or if you say, hey, I think Boeing is literally, let's say I think Boeing's going to go to 380. Instead of saying, oh, well, what if this option will have to go here, that's just buying an option and hoping it goes to that price. But if let's say you're like, hey, my price target on Boeing is 380, the key is to understand now, if you want to make money on the contract, it just has to go in the money. So if you think it's going to go 380 and just want to get $1 in the money, because then if you could buy the contract at 10 cents, that it will be worth 1,000% right there. you go $1 below where you think it's going to go to. Now, in this case, it's spread out by $2.50 increments because it's a bigger price stock. So maybe we could try this on a different one. Let's try Snapchat. See, because these are dollar increments. So let's go out. Let's go out to a longer term. Let's go to a January or April 2020. My April didn't load, so let's go here. But let's say I think by end of the year, and again, this is not what I think. I'm just using this as a hypothetical example. I think that Snapchat is going to go to $20. Or in this case, actually, let's say I think it'll go up to $25. But in this case, if I think it's going to go to $25, that doesn't mean we buy the 25 strike because, again, if it goes up to the price of the coupon, we lose money. The key would be I would want to get at least $1 in the money. So in this case, I would go one strike price lower and then do the calculation here. And guess what? If come January 17th, if it goes to $25 like I expected, this will be worth at least $100 by expiration. And if I buy it for 30 cents is what I pay for it. The contract will be at $100. That's about a 200%, 300% gain. Boom. I could figure out, okay, is it worth it? But if I'm saying, well, now if I wanted to make 1,000%, I would actually need this 30-cent contract would have to go $3 in the money. So if I bought the 24, that would be assuming I thought it could go to $27. Ta-da. So again, we could even use Snapchat as that example if we wanted to. So take a look. So current price, this is what we fill in. So Snapchat's at $15.85. Boom. The strike price would be 24 and the contract price is 31 cents. And as you see here, it says the ask. You see, I taught my students well, baby. You guys know what to look for. So 31 cents right there. You could see amount in the money. Boom. Right there. It just did it. You see, I could do this in my head, and I encourage you all. This is simple math. You don't need to be a rocket scientist, but it's saying on the call side, the price to reach would have to go to 25. So again, we got the strike price 24. It would go $1 in the money. So to get $1 in the money, if the strike's at 24, it would have to go to 25. The percent move to be there would be 57%. So it's saying from $15.85 to $25, that's literally a 57% move, and it would be a 322% gain. So ask yourself, is it worth it? So for me if I bought that January Snapchat call now, I would make 300% if the stock moved 57% in the next 5 months. See, and then it did the same exact thing there on the put. So then if I wanted more now, let's say if I wanted to get $2 in the money, to get 600%, it would have to move 64%, $3 in the morning. To get 960, I would have to get $3 in the money, and that would take a 70% move. And then you could fill it in vice versa with the puts. But as you see, simple math, and that's the point of it. Now, I'd ignore these for now because now this is everything I've already told you guys to figure out the percent of the move, figure out the appropriate strike or percent gain in the money. Again, this is very simple. If you wanted to get now, if the option cost 40 cents, you would need to get $4 in the money to get 1,000%. Simple as that. If you want to figure out the price of what it is, if you're expecting now a 5% move, so let's go back to Snapchat, the current price is $15.85. If I think Snapchat can move 10%, I don't know if this is updated. I got to figure out how to use this, but this would essentially shoot you out what you think's going to happen or what you would expect. And but this is what I'm saying. You could backwards work this whole formula to get whatever you want. So again, if you can't pick the option, you could look at the stock. So again, in that case that I just said, if I think in the next few months Snapchat's going to move 10%, all I would have to do is take $15.85 times 0.10. That's $1.58, and boom, add that above or below. That's $1.58 move, and then if I need to get $1 in the money on both sides, add an extra dollar, so $2.58, and boom, $2.58. Take $15.85, add $2.58, $15.85 plus $2.58. On the call side at $18.43. So at $18.43 would be $1 in the money. So actually, if this closed $1 in the money, I would actually lose money if I bought it for $125 because $1 in the money would only guarantee this is worth 100%. So again, hopefully you're seeing that could get a little bit more confusing, but at the end of the day, you could do all these calculations of just saying, hey, this is what the strike price is at. If it had to, and really this is, if you figure out where you think it's going to go, always add $1 or $2 or however much you want it to go in the money and subtract it by where the stock's at, and just to figure out the move. So that's probably the part that most of you guys will get caught up on. So again, let's try it on one more stock, maybe Facebook, and I'll do it here so you guys could get a quick example, because I don't want you guys to get confused, because now this is how to price in. Well, what is the market pricing in? This is like the calculation. When we say that the stock needs to go up 4% or the market's pricing 4%, once you know how to figure this out, you'll see how this all falls in line. So let's go to the September 20th now. Again, right here, let's say, so boom, 19 cents. Again, 10 cents is always the best. So let's say by September 20th now, we need this to, for this to go 1,000%, if we bought it at 10 cents, we need it to go to 211. So even though this is the key, again, even though it's a 210 strike, to get $1 in the money, you need it to go to 211. So take 211 minus by where it's trading at now, 85.22. That's a $25 move. So where does this number come from? Think about it. If the stock's trading at 185.22 from right here, right now, if it went up $25.78, this would make it where the stock would be trading at $211, and that means this contract would be $1 in the money, and it would be worth at least $100. And you bought it at 10%, at 10 cents. That is now 1,000% move. So now the next step, this is how you say, well, what does it take for a stock to get there? You know it would take $25 to get $1 in the money on this contract. So if it's trading at 185.22, divide this by the current price that it's trading at, 185.22. Boom, you're left with 13.9%. So if by September 20th, Facebook moves 13.9 or 14% from here, this contract will be worth 1,000% from where it's at right now, if and only if you bought it at 10%. Or 10 cents. I don't know why I keep saying that. But that's pretty much it, guys. Hopefully this blew your mind. Hopefully this taught you something. And again, if somebody wants to go through and tag the parts of this, like you mad, shout out you mad, baby. But at the end of the day, too, I don't think you should skip ahead with this video, and I think everybody should watch all the way through. But this went really, really in depth, and hopefully this takes your game to another level. So again, you guys, drop your like. Let me know your feedback. If you have questions and you comment them below, we'll cover them live, or I'll make a follow-up video for you guys. And make sure you share it, and God bless all of you, man. I love you all, and I want to see you guys keep learning. So hopefully this helped. Hopefully this gave you some more insight. You know, I could get real sentimental with you guys. I just want to see you do good. So hopefully this gives you some of that gas, baby. Let's go!